Adjusting journal entries is the fourth step in the accounting cycle, used to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. There are four key scenarios when adjusting journal entries. Scenario 1, deferred revenue. Sometimes companies receive cash before providing a service. Therefore, it has deferred revenue. For example, Qantas receives your money before you fly with them. Qantas would originally record in the general journal an increase to a liability account, aka the unearned revenue account, since they owe you the service of flying with them. However, once you have flown with them, Qantas will adjust their journal entry by reducing a liability, which is the unearned revenue account, and increase a revenue account. Scenario 2, accrued revenue. Sometimes a company will provide a service and then collect the cash. This is known as accrued revenue. The adjusting entry will therefore be an increase to an asset account, which is usually a receivable of some sort since they owe you cash, and an increase to a revenue account. Scenario 3, deferred expense. Deferred expenses are when a company pays for a resource before it uses or consumes it. For example, when a company buys a resource such as a truck, the truck will depreciate over time. First, you need to calculate the amount of depreciation. The adjusting entry will be an increase to an expense account and a reduction to an asset account. Therefore, in this case of depreciation, it means accumulated depreciation, which is a contra asset account, will decrease and the depreciation expense will increase. Scenario 4, accrued expense. Companies often incur expenses and pay them later, for example, interest expenses. The adjusting entry will always be an increase to an expense account, such as interest expense, and an increase to a liability account, such as interest payable. Pro tip: when adjusting journal entries, cash is never ever an account title used. If you use cash when adjusting entries, you are going to get the answer wrong. This is because the basis for adjusting entries is the accrual basis of accounting and not the cash basis of accounting.